Thank you, everyone, and welcome to the July edition of the monthly webinar series. I'm Brian Dangerfield, as mentioned. I co-head G10 Foreign Exchange Strategy at NatWest. I'll be your host today. Unfortunately, due to an unexpected personal conflict, Piers Leslie, who normally joins to discuss technicals, is unable to join us today. So today we're going to focus a little bit more on the fundamental side. Look forward to having Piers joining in the future, but he won't be on the call for this edition. As always, please use the Q&A function. We'll get to some questions at the end of the presentation. I'll go for about 10 or 15 minutes or so, and then more than happy to open it up for questions. It's almost hard to believe that we're now into the second half of 2026. And I really wanted to focus today's call on some of the, how we're thinking about the second half for major currencies. And then with a particular focus on the dollar, that's sort of my backyard, the outlook for the dollar, because that tends to be such an important driver of not just currency markets, but global markets. And it's really the central point of our forecast that essentially with the dollar will go major currencies. If the dollar is strengthening, major currencies writ large are going to be weaker and vice versa. And that moves in major currencies on crosses are probably going to have some delta to that big dollar move. And I won't bury the lead here. I'll just make the point that relative to the first half of the year, we ourselves upgraded our expectation for the dollar, but we still see it weaker in the back half of 2026. We just think the scale of that weakness and the timing of that weakness is probably going to be lesser than we had thought at this time a few months ago. And that really reflects two primary drivers, two concurrent themes that we've been tracking on the global macro side. One is the U.S. outlook, the cyclical picture, and the other is Iran. So let's move into the slides, and we'll start with Iran. U.S.-Iran war risk, escalation risk has certainly reignited here. I make the point here in just a couple of very simple slides. The evolution of the Brent futures curve, the front European oil future is on the left-hand side, showing a couple of important dates between where we've seen differential. That blue line is where oil prices were before the war. That's February 27th. The green line is where we were the day of the ceasefire, just to give you a sense of where oil had traded. And then where we are currently is that dark purple line. It's almost hard to see because of how it coincides with the future months forward. What we're trying to show in this chart is just how much the front futures, the near-term contracts, surged relative to their more forward-looking counterparts. So, for example, the rise in the 1 month front future at its peak was $40 to $50 a barrel. Whereas in the long-term contracts, even at the peak of escalation, those long-term contracts did not rise nearly as much during the onset of the Iran war. What that's telling us is that markets for the duration of this conflict have been pricing it as a short-term temporary supply shock, that the most intense of the supply shortages are going to be felt in the nearest months, and that while oil prices are higher across the projection, they have not been nearly as high. The move, say, in 2027 futures prices, 2028 futures prices, that move was always more muted than the moves in the very front end. What we've seen more recently is that while front contracts have come down, we're actually still at those relatively elevated prices compared to where we were in February before the start of the conflict. So what I think, what I read from this is that the market still trades on energy contracts on the futures market with a somewhat optimistic bias that the worst of the acute conflict has already passed and that future oil supply disruptions are going to be lesser. And that's sort of reflected in the fact that the uptick in the more medium-term futures prices were not nearly as large as they were in the front end. You can also see in foreign exchange markets how this more recent escalation has not translated really at all into currency volatility. So on the right, we show the CVIX, which is an index of currency volatility. It's a Deutsche Bank index widely cited. That index continues to move lower. Now you can see where it moved higher in the beginning of the year, in part reflecting some the U.S. rate check in dollar yen in January, and then again the U.S.-Iran war beginning in February and into March. But since that time, we've seen for the most part a steady move lower in volatility, and this is true in FX, but also in cross-market volatility. And so when I look at FX markets and I think about how these latest Iran escalation threats are feeding into FX markets, what I continue to see is a market that is trading with an optimistic bias. Now, that might be right or wrong. It could be proven right or wrong. But I think the markets, the way volatility has shifted lower, how the dollar has remained range bound, albeit towards the top of its recent range, I think that's reflecting a market that sees the worst of the crisis being behind us in terms of how it impacts markets, that future oil supply issues are going to get better rather than worse. Now, this is an assumption that can absolutely be challenged. I think everyone is aware of the significant uncertainty, but the way that markets are trading sort of reflects this idea that the markets still believe that the president in the US is unwilling to take significant new escalation, such as, for example, troops on the ground or an extended campaign that would see the war fully restart and full suppression of energy supplies. Energy markets, of course, there's other factors as well. There's how much excess reserves are there, strategic reserves, releases of reserves that can help offset energy prices. So it's not just all about the specific state of the war, but in FX markets, what we've seen is this on and off, this escalation risk has just not translated into significant market volatility in foreign exchange. And I think all else equal, that's probably a modest negative for the dollar if we're seeing an environment where volatility is low, and that's encouraging carry trades and risk sensitive trades. Can you move to the next slide, please? So from an economics perspective, I think it's right to say that escalation in the Iran war has broadly been seen as a positive for the US dollar and the US economy relative to its peers. Not to say that the war is a positive for the US economy, but as a oil exporter and producer, the US exposure to higher energy prices, higher imported energy shortage risk is just so much lower than in other economies. And the market's first order assumption at the onset of the Iran war was to move higher in terms of move the dollar higher. And I think that was appropriate. One of the things we were watching at the time, if you're a frequent listener or a consumer of this series, you'll have heard me discuss positioning and why I think that's so important here. And on the left, we show a proxy of positioning against a proxy of the scale of economic surprises in the United States. At the onset of the war, you can sort of see right where that January 2026 label is. That purple line at its negative level is showing that CFTC positioning data suggested that markets were broadly short of US dollars heading into the conflict. That has changed dramatically over the last few months, where that purple line has just been shot out of a cannon. And now, if you look at those same survey measures, CFTC net positioning in dollars among speculators, I should clarify, is actually flashing near its highest, most long levels since 2019. So think about the period of dollar exceptionalism, US growth, significant outperformance, significant rapid Fed interest rate increases. Dollar positioning, at least on these surveys, is actually at those types of levels, even though I don't think the economy is at that level of exuberance. So positioning, I think, really does matter here. And that at the moment, dollar positioning is probably a risk here, that a lot of good news for the US may now be in the price. And to be fair, one of the things that has changed over the last few months is that the economic data in the US, the cyclical backdrop, has certainly improved. We look at it a little bit with the surprise index. We'll touch on it in greater depth in some charts coming up. But the blue line on the left-hand side, that's the surprise index. That is the economic data beating to the top side or the downside versus consensus. You see that level also has moved to its highest level in a couple of years. Just telling you that the persistence and scale of economic surprises to the top side has generally been quite large. And so as conditions have adjusted, the cyclical conditions have adjusted, and the Iran war forced a positioning move, those two factors in parallel helped boost the dollar. One of the things that we had been tracking very closely at the onset of the war was the evolution of the dollar versus interest rate differentials in the front end of the curve. This tends to be a really good relationship with foreign exchange markets. We'll show this chart again on a longer trajectory later in the presentation to give you a sense of how good that relationship once was. We have seen signs of it weakening recently. The Liberation Day period from April of last year is a really obvious one. But more recently with the Iran war, at the onset of the Iran war, what we saw was a stronger dollar represented by the DXY on the right-hand side. But we did not see a corresponding increase in interest rate differentials in its favor. If anything, what we saw was higher yields everywhere, but even more upside in yields in places like Europe and in the United Kingdom and in other economies, because the markets were assuming that those economies were maybe more likely to have to hike interest rates more sensitive to higher energy prices than the US Fed would be, especially with new leadership coming in that most believe, and I still believe, will ultimately have a dovish influence on policy. And so at this point in the cycle, if you are a frequent listener to this call, you would have heard me say something like, this is a reason to be wary that unless the cyclical outlook really starts to improve and pushes interest rate differentials higher in favor of the US, allows US yield upside to catch up to the rest of the world, then the dollar might be running short of steam here. It's not supported by interest rate differentials. Instead, this feels more of a positioning correction that may run its course if the data doesn't cooperate. The data have since cooperated. You can see just how much interest rate differentials, that dark blue line, have moved back up. And so the cyclical picture has certainly improved over the last few months. But the question that always we are asking ourselves is that with positioning where it is now, do we think too much, all of the good news is now priced, and what are the risks to the outlook from here with inflation and growth both in major focus? Can you go to the next slide, please? So let's talk about the labor market first. The labor market has certainly firmed, and the unemployment rate has been very stable. We are still in what I consider a low hire environment where hiring intentions have generally remained low. There are some signs that hiring intentions may be showing signs of stabilizing or even picking up a bit. Things like the JOLT survey, job openings and labor turnover survey, they're telling us that maybe there is some stabilization there. I think stabilization is kind of the word of the day when it comes to the labor market, that after a period of slow but steady declines in the 3-month moving average of private payroll growth, that's on the left-hand side. At the beginning of the year, we saw a couple of months of strength. The most recent number for June that was released earlier this month was a bit softer than the benchmark, but the overall picture is one of more stability at some slightly higher levels in terms of absolute job gains. And so I think this is one of the reasons why interest rate differentials have moved as they have, that the market has gotten more comfortable with the US labor market, with the risk to the downside maybe being a bit more limited here. But that's not to say that there aren't still some signs of potential softening in the labor market that you can find. It's particularly apparent in the survey data. I would add that gains in the labor market for a long time have been heavily concentrated into healthcare and social assistance. The fact that job growth has remained very, very strong in that sector has, I think, maybe not necessarily masked, but maybe overshadowed some continued weakness in private sector hiring in the overall economy. My personal sense is that because of an aging population, that healthcare hiring is likely to be almost structurally strong in nature and maybe not as sensitive to a slowing in the cyclical backdrop. What I show in the survey data are two that our economists like to look at, and certainly I do as well. One of them is the Conference Board labor differential. This is a survey data where you ask consumers or job seekers, do you think jobs are plentiful right now or are they hard to get? And as that number comes down, you're seeing that differential move in favor of jobs are getting harder to get. It's a sign of loosening in the labor market. Again, we still don't see a negative number there. It's not like we have a massive weakening in the labor market. But you've also seen small business hiring intentions. That's the dark purple line on the right-hand side. Those have also come down. Small businesses are a really important part of the hiring backdrop here in the United States. And that softening, I think, is so important. And so the labor market, I think, is still in a let's call it a cautiously optimistic posture where there are certainly signs of stability. The unemployment rate being remarkably stable as the main thrust for Fed policy is really important and I think a very big positive. But that doesn't mean you don't see signs of softening around the edges. It's just a question of whether or not confidence and survey indicators will lead into hard data, because we've had a couple years here where the survey indicators haven't always given you the best indication of where the hard data is going. Can you move to the next slide, please? Inflation is also right now the really notable one because, of course, with the Iran war and associated risks to the upside through energy prices. Now, those energy prices have certainly come down, but I think as a top line risk for the Fed, it's very clear that policymakers, not just in the US, but everywhere, are more focused on inflation right now than they are on growth. This week, we got very, very encouraging data on inflation here in the United States. We had headline CPI that was negative on a month-to-month basis. We had a core inflation print, more notably, which was flat on a month-to-month basis. A big under surprise in the consumer price index. We also had a downside surprise in the producer price index, the intermediate prices. And you never want to put too much emphasis on one piece of data, but we do think that this could be the start of further moderation over the next coming months in core prices. So on the left-hand side, we look at core inflation, some key aggregates. Housing, we've known for a long time that within the PCE deflator, the Fed's preferred measure of inflation, that housing and rents look like they're probably going to keep coming down just based on how they're measured. There's been a bit of a lag in terms of how rent prices have translated into inflation. We also think core services, excluding housing, is sort of approaching its peak here and maybe showing signs of easing back as you head towards the end of the year. Similar with core goods, although that's going to be a lot more sensitive to the specifics of energy costs. That if we have a big spike in energy prices, then that picture is going to look a notable ways different. Where this translates into my thinking about the next coming months for the Fed is that the annualized core PCE deflator, annualized the 3-month annualized. So what's the 3-month trend if you project it over a full year? I think that gives you a really good sense of, the direction, the trend of inflation rather than a single month. And in our projections, this chart here shows our own house projections. You've obviously bounced a lot, quite a bit in terms of core inflation, but we do think we're on a bit of a downswing here. And that by the time we get into the third quarter and into the fourth quarter, we're going to have core PCE numbers that on a trend basis are looking closer to 2% than not. And so with this in mind, we think optically lower energy prices are helping reduce headline inflation, but we importantly expect some easing in core inflation as well. And so we think the case for Fed tightening is probably going to be reducing over the second half of the year if our view on underlying inflation is right. The data we got this week in the US was very encouraging on that front. One number does not make a trend, but in our projections, we think there's more easing back of core inflation coming that could make the Fed a little bit more confident. Can you go to the next slide, please? So how does this all translate into the Fed? As mentioned, we don't think the Federal Reserve will hike interest rates this year. We actually think we have a couple of interest rate cuts in our projection in 2027. Now, this is a change from our previous view. We had previously thought that cuts could come sooner. Part of that change, of course, reflects, as mentioned, the Iran war and associated risks. But similarly, the fact that the cyclical backdrop has improved simply can't be ignored. That we ourselves think that the timing of potential rate cuts has been pushed back. It's very clear that the incoming Warsh chairmanship at the Federal Reserve, he hasn't had the flexibility to ease interest rates that we thought he might have at the beginning of the year. The Iran war has a big piece of that, but as mentioned, the stronger economic data are still quite important. This is not just an Iran and energy story. There is a better cyclical backdrop here. And so relative to the market, which is still pricing interest rate hikes as the next move, we do think that the market is probably still overpriced here for interest rate hikes. And just to sort of bring back to interest rate differentials, the dollar's relationship with interest rate differentials in the front end historically has been very, very strong. And so what this sort of calls back to is that the difference between your call and the Fed and in the market in terms of the Fed call translates really well into evolution of front end interest rates and how that translates into FX as well. And so because we think the Fed is unlikely to hike interest rates, we do think that some further easing back of interest rates could influence a weaker dollar in the back half of the year. But a lot of that, of course, will depend on, if we're right about the evolution of the data, particularly on the inflation front. We also happen to have a little bit of weakness creeping into the labor market, although to date that hasn't really happened. And so that stability in the labor market presents an upside risk. Similarly, we could be wrong and the markets could be much more eager and in a position to price greater downside risk to global economies from higher energy prices if the Iran war escalates. Those are potential risks. But all of that comes with the dollar in terms of positioning, with the markets, I think, leaning a lot more long rather than short as they were at the beginning. And so maybe there's a little bit less juice in the dollar rally if we see a little bit of stronger data and a little bit of higher energy prices. Can you move to the next slide, please? So now I'm going to put on my best Paul Robeson impression. Paul Robeson, for those who are familiar, certainly with this call, he's a frequent host of this call. Co-heads G10 FX strategy with me sitting over in London. I do want to talk a little bit about euro and sterling here. And the big point on euro dollar that we have been making as a house is that euro dollar through this crisis, through the Iran war, has been trading extremely close to our estimate of short-term fair value. As you can see on the left-hand side, there's been very little deviation. And that's not to say that we retrain this model every day and so it helps create the fit. It's just that the euro has been trading pretty clearly in line with some of its key fundamental drivers, things like short-term interest rates, as mentioned. One of the drivers in our model is EU spreads, Germany versus a combination of French OATs and Italian BTPs. And so one of the things that we're tracking is the European political situation, some recent headlines around France. We did have periods at times previously where concerns around French politics and going back even further, Italian politics and regional politics in Europe in general have at times had a negative impact on euro. That's something that we'll be tracking, but that's a very forward-looking risk here at this point. At the moment, it feels like euro dollar is still going to be driven by these fundamental factors, that it normally tends to be driven by, with a really big piece of that being the outlook between the European Central Bank and the Fed. And if we're right that the market has to price back some expected tightening from the Fed and ultimately maybe move into a position where rate cuts come back into the fold in 2027, that could be part of a stronger euro story in the back half of this year. Another factor for euro that we're, of course, tracking is de-dollarization as a long-term concept. Has clearly taken a back seat recently because of the stronger fundamentals in the United States. But we don't think that that's completely gone away as a potential long-term driver. The euro is probably best positioned to absorb any type of de-dollarization funds if you're looking at potential asset rotation. Europe is a region still with a current account surplus, excess savings that get recycled into other external assets. If we do see sort of resumption of de-dollarization as a theme, could find its way home. And so that is something that we are tracking as still a potential medium-term driver of euro dollar. Can you move to the next slide, please? And finally, a word on sterling. The resilience here. This has really been the story for sterling, the resilience. I show euro sterling here, but it's very similar, of course, with sterling euro, the inverse pair, where sterling has reached its highest level in a little over a year against the euro. And I think the big question that we get is the political uncertainty and how the market has effectively shrugged off some of that uncertainty, or at very least maybe pushed out the timing of those concerns. We have, of course, seen times when the sterling has been sensitive to political risks, to concerns around budgets, and to gilt yields and concerns around gilt supply. Sterling has shown sensitivity to that before. So we have to acknowledge those risks and how the political uncertainty around changing leadership could ultimately feed into sterling. But I think what we have seen is that the market simply doesn't have a long enough time frame at this moment. Volatility is very low. And these concerns, while they may start to build as we head towards the autumn budget, at the moment, it feels like the market is almost throwing in the towel on a very pessimistic view on sterling, which is in part linked to these concerns, the potential concerns around politics. The other thing that Paul pretty frequently mentions is the improvement in inflows into UK equity ETFs. That's shown on the left-hand side. That this is an important driver that, at the end of the day, foreign exchange is a flow product. And as, if additional investors are looking to maybe invest in the United Kingdom, whether that be by equities at valuations that are certainly quite a bit lower than they are in the United States. That's the kind of thing that can move the needle that maybe isn't as sensitive to what we're always talking about in this world, in these kinds of calls, which is relative interest rates. Because you can see that euro sterling versus relative interest rates, that purple line coming way lower, that's the sterling getting stronger. It really hasn't tracked with relative interest rates. And so it could simply be a reflection of positioning, markets maybe shifting away from a more pessimistic bias because of some potential concerns around politics that just really haven't materialized into the FX at this moment. And so sterling resilience has really been the story throughout the Iran war escalation, and it remains an important theme today. So with that, I will conclude the prepared remarks. As a reminder, please use the Q&A function to submit any questions. I will go on mute for a moment to peruse potential questions, but please don't be shy. Certainly more than happy to engage in conversation and would love to hear your questions. Thank you.